Be fearful when others are greedy and greedy when others are fearful. This famous quote from Warren Buffett perfectly encapsulates the counterintuitive approach needed to successfully navigate market crashes. When markets plummet, fear takes hold, and investors often make rash decisions. This is precisely when opportunities arise for those who can maintain a clear head and capitalize on the situation. This guide serves as your roadmap to not just surviving market crashes, but emerging from them stronger. We'll demystify these events, delve into effective strategies for capitalizing on them, and empower you to become a savvier investor. Remember, knowledge is your greatest asset, especially when the markets get turbulent. So, buckle up, and let's turn market turmoil into potential profit. Let's start by defining what a market crash actually is. In simple terms, it's a sudden and dramatic decline in stock prices across a significant portion of the market, usually over a short period. Picture a roller coaster plunging from its peak. That's a market crash in action. But what triggers these financial freefalls? Well, several factors can ignite a crash. These can include asset bubbles inflating to unsustainable levels, unexpected economic slowdowns, geopolitical shocks like wars or pandemics, or even just plain old investor panic. Understanding the anatomy of a crash is the first step towards navigating it effectively. By recognizing the warning signs and common causes, you can be better prepared when the market takes a turn for the worse. History is a powerful teacher, especially in the world of finance. By looking back at the past, we can gain a deeper understanding of the forces that shape our financial markets today. Examining past market crashes provides invaluable insights into their nature, duration, and recovery patterns. These events, though often devastating, offer lessons that can help investors and policymakers navigate future challenges. From the infamous crash of 1929 that triggered the Great Depression, which saw the stock market lose nearly 90% of its value, to the widespread economic hardship that followed, this period remains one of the most studied in financial history. To the more recent dot-com bubble burst in the early 2000s, where exuberant investments in internet companies led to a dramatic market correction. Many tech stocks lost a significant portion of their value, leading to a prolonged period of market stagnation. And the 2008 financial crisis, which was triggered by the collapse of the housing market and the failure of major financial institutions like Lehman Brothers. This crisis led to a global recession and required unprecedented government intervention to stabilize the economy. Each downturn has its unique story to tell. The causes, impacts, and recovery processes of these crashes vary widely, but they all share common themes of fear, uncertainty, and eventual recovery. Take the 1987 Black Monday crash, for example. This event saw the Dow Jones Industrial Average plummet over 22% in a single day, a record drop that sent shockwaves across the globe and tested the resilience of financial systems worldwide. Despite the severity of the crash, the market rebounded remarkably quickly, recovering its losses within 2 years. This rapid recovery demonstrated the underlying strength and adaptability of the financial markets. Investors who remained patient and did not panic were rewarded as the market regained its footing and continued to grow. These historical examples teach us that market crashes, while painful in the short term, are a natural part of the economic cycle. They remind us that volatility is inherent in financial markets and that downturns, though challenging, are often followed by periods of growth and recovery. They also highlight the remarkable resilience of the market and its ability to recover and reach new heights over time. By studying these past events, we can better prepare for future market fluctuations and maintain a long-term perspective on our investments. Section 4. Keeping your cool, the long game of investing. Investing is not just about making quick profits. It's about building wealth over time through patience and strategic planning. When markets tumble, it's easy to get swept up in the sea of red arrows and alarming headlines. The media often amplifies the fear, making it seem like the end of the financial world is near. Fear and panic can lead to irrational decisions, often resulting in selling at the worst possible time, locking in losses. This emotional reaction can be detrimental to your financial health. This is where a calm mindset and long-term perspective become your biggest allies. By staying composed and focusing on your long-term goals, you can avoid the pitfalls of emotional investing. Remember, investing is a marathon, not a sprint. Just like training for a marathon, successful investing requires discipline, endurance, and a clear vision of the finish line. Short-term market fluctuations are inevitable, but they shouldn't derail your long-term financial goals. These ups and downs are part of the natural market cycle. Instead of fixating on daily price swings, focus on the fundamentals of your investment strategy. Understand the companies you invest in, their growth potential, and the overall market trends. By tuning out the noise and sticking to your plan, you can weather the storm and come out ahead in the long run. Consistency and patience are key to achieving your financial objectives. Remember, market crashes often present buying opportunities for those who keep their cool and maintain a long-term perspective. By viewing downturns as chances to buy quality stocks at a discount, you can enhance your portfolio's potential for future growth. Ultimately, the long game of investing is about staying the course, making informed decisions, and having the confidence to stick with your strategy through thick and thin. With time, patience, and a steady hand, you can achieve your financial dreams. Section 5. Strategic Maneuvers. Investment Strategies for Market Downturns. While riding out a market crash with a cool head is essential, it's not about passive inaction. Instead, it's about making calculated moves that can set you up for success when the market rebounds. Downturns present unique opportunities for savvy investors to strategically position themselves for future growth. By understanding and implementing certain strategies, you can turn a challenging market environment into a period of potential gain. Here are a few powerful strategies to consider, each designed to help you navigate through the turbulence and come out stronger on the other side. First, dollar cost averaging, or DCA. This is a time-tested strategy that can help you manage market volatility. This technique involves investing a fixed amount of money at regular intervals, regardless of market conditions. By doing so, you spread out your investment over time, which can reduce the impact of market fluctuations. When prices are down, you buy more shares, and when prices are up, you buy fewer. This approach can help you avoid the pitfalls of trying to time the market perfectly. DCA helps mitigate the risk of buying at the peak and potentially enhances your returns over the long term. Second, increasing investment amounts. This strategy requires a bit more financial flexibility, but can be highly effective. If you have the financial flexibility, consider increasing your investment contributions during a downturn. This allows you to take advantage of lower prices and buy more shares at a discount. This allows you to buy more shares at discounted prices, potentially amplifying your gains when the market recovers. It's a bold move, but one that can pay off handsomely if executed correctly. Third, strategic use of leverage. Leverage can be a double-edged sword, magnifying both gains and losses. Leverage, like margin accounts, can magnify returns but also amplify losses. It's crucial to understand the risks involved and use leverage judiciously. If used judiciously and with a solid understanding of the risks involved, leverage can be a powerful tool to capitalize on market drops. However, it's not for the faint of heart and should be approached with caution. Fourth, portfolio rebalancing. Market crashes can throw your portfolio out of whack, disrupting your asset allocation. Rebalancing involves selling assets that have performed relatively well and buying more of those that have declined. This helps you maintain your desired asset allocation and manage risk effectively. By regularly rebalancing your portfolio, you can ensure that you are not overly exposed to any single asset class. Remember, every investor's situation is unique. What works for one person may not be suitable for another. Carefully consider your risk tolerance, investment timeline, and financial goals before implementing any of these strategies. Consulting with a financial advisor can also provide personalized guidance tailored to your specific circumstances.